pretty good, mate. How you going?
No complaints. We're back out of financial year, which is nice, and
Yes.
into
Next financial year,
next
where we start
financial
doing all the
year.
planning again.
Yeah, correct.
Yeah.
So, but otherwise good.
That's good, man. Yeah, it's been a little bit happening in markets in the last 12 months, really, but
Yeah.
in the last quarter as well. So we'll spend a bit of time today going through it, shall we?
Yeah, definitely.
All right.
I think there's a few themes happening at the minute, but let's walk through it.
All right. So firstly, GDP growth. GDP growth in the US is still pretty strong. So
Yeah, it's fantastic.
quarter on quarter, 0.4 is what they landed.
Yep.
And the year on year was 2.6.
Yep.
So that's still pretty decent considering where they've come from.
And considering what's happening, we've got all sorts of global conflicts going on, at least that have Western involvement.
Yeah.
And then there's some, I wouldn't call it civil unrest, but I wouldn't call it civil harmony either in the US. So it's interesting to see that that's relatively close to probably where they would like to be. It's not a terrible number.
Yeah, that's right.
Yep.
The on again, off again war in Iran that continues to. I'm not currently sure if it's on or off.
Yep.
There's talk
Changes
of a
every
ceasefire
12
overnight.
hours,
Obviously, the Euro area as well. So they've been struggling over the course of the last 12 months or so. Well, they've had some very small amount of growth, 0.3. Japan's been good for probably 12 or 18 months now. We've looked at a year on year of 1.5.
Yeah. Yeah.
So going along okay. So world economies, top G3 is looking okay from a GDP growth perspective, which, as we know, is a lagging indicator.
Correct.
But that's still looking pretty strong. Back to Australia, domestic growth is running probably a bit below trend, I think.
Not surprising. I think, well, anecdotally at least, in terms of conversations that we have with clients.
Yeah.
I wouldn't say people are overwhelmingly optimistic about the state of our nation fiscally
Economy,
at the moment.
yeah.
Yep.
And we'll get to a little bit of that in a minute. Consumer confidence numbers are still pretty poor, but the GDP growth last quarter rose 0.3% for the quarter.
Yep.
We're looking at 2.5% for the year. Interestingly, and something we'll pick up on later, GDP per capita, which is per person, fell 0.1% for the quarter.
Yeah,
So
interesting.
what we've seen, and that's actually 1% for the year, but it seems to me what we're seeing there, and it's been like this for a while in Australia, GDP growth per capita, the economy is really only growing at the moment because the Australian population is growing.
Yeah. That's been a theme for a while.
Yeah. And we'll go into a little bit later. We've got some slides on that we'll spend some time looking at.
Yep.
So contributions to GDP growth, we saw household consumption make up the vast majority of it. Business investment, so businesses are still investing.
They're still investing, which is a good sign.
And exports as well, and then imports is the major.
Yep.
Always the major issue. So it's going along okay, GDP growth in Australia, but it's still probably running a bit below trend.
Yeah. And I just think in terms of, we talk about consumer confidence. I think that's, as you said, lagging indicators. We want to try and look forward and take the metrics that we can to sort of see where do we head from here.
That's right. Just a bit on inflation. As you know, inflation has been up and down quite a bit in the last little while. So we got to that peak of 8%, which is an extraordinary number, certainly in my lifetime.
Yeah.
Back in COVID, and then it fell back into the target band. So the target band between 2% and 3%.
Correct.
We've now seen it start to rise a little bit. So the latest headline numbers, when we've put these slides together, the slide pack together, is 4% annualized.
It's getting there, and I think this is playing out right in terms of consumer confidence, because I think when inflation started to fall and rates were coming off, people were getting a bit of mortgage relief. Obviously, inflation's going down, prices of things are coming down, and now we're kind of going back the other way. And it's so close, I suppose, relatively to where we were. I think there's a bit of a psyche connection there where people are like, well, I don't want to go back to where that was, and so we're much more cautious
Well, of course, we've had 3 interest rate rises too,
Yeah.
right? So that pulls inflation back, and we've started to see from the previous month it was down from 4.2 to 4 annualized. So it is starting to have a bit of an impact. But that's still too high. So Reserve Bank at the moment,
Yeah.
what do you think they're going to do next?
Well, they don't have many options.
Raising?
Yeah.
You reckon
Well,
they're still going, or going to been on hold?
I think they'll continue to hold for the time being until to see more data. I think the really big point here is going to be petrol prices and what happens with Iran and the input cost that then has into transport and the amount of things that petroleum goes into in terms of the supply chains of making things. Then that's going to have its knock-on impact. So I guess we'll wait and see. Really, but my expectation would be holding until the data says otherwise.
Anecdotally, the petrol price is sitting, at around about where it was before this whole war in Iran occurred. So I filled up the other day. I think I paid for diesel $2.12, something like that.
That's not too bad. Yeah. But you just don't know.
No, the uncertainty is problematic, isn't it?
It just makes it really incredibly difficult. And I think that's probably the biggest, aside from social causes that people have issues with, I guess the Trump presidency is the uncertainty that it creates, and the knock-on effect for everybody. So anyway, I won't get into the politics of that, but it definitely plays itself out.
I heard yesterday that just on the Trump presidency, the US government started to pay back the tariffs that they received illegally, according to the Supreme Court. And I think as a result of that, I don't want to get this number wrong, but it could be. I think it was $50 billion that they paid out last month back to businesses. So, which then created the largest deficit that they've had in any one month. So
it's interesting that's gone very quietly around. Like there hasn't been any huge amounts of
there was no
huge
amounts of
fanfare. Yeah, correct.
Yeah, we're just going to pay it back.
We've paid it back. Yeah, look how good we are. Yeah. So anyway.
All right. In terms of households, and this gets to our consumer sentiment discussion from earlier. So, consumer sentiment at the moment is actually at where it was in COVID times, just post COVID. So people are not feeling, they're not feeling wealthy, and they're feeling the effects of, inflation, food price inflation, fuel inflation, interest rates going up. And so as a result, people are not feeling great. Now that's as we saw earlier when we're doing the contributors to GDP growth, that's a really significant.
60% of GDP typically historically.
Consumers.
So why people focus on this metric, it's so important because it's a reasonable, whilst it's a lagging indicator, it's a reasonable indication of what to expect, at least in the shorter term. But hopefully as we move through the next few months, we'd like to see that number turn around.
Yeah. The other thing that this slide, I'll just point out on this slide as well, is disposable income is turning down as well, and as has consumption, and the savings ratio has increased. So people are, because they're feeling like a bit worried, they're starting to try and save a little bit more, and that's been reflected in the numbers.
Yeah, absolutely. I think the anecdotal conversations we have with clients, that's a fair reflection, I think, of the psyche, at least of our cross-section of clients.
Yeah. House prices.
Miss Chestnut. Yep.
It's one of these things that comes up very regularly and very often. And before we go into this, I'm going to tell for a little quick anecdote. You tell me not to do this, but
why?
I don't know. I seem to want to. So I was clearing out the back shed the other week. And in the back shed, I had a whole bunch of work stuff from when I was in my mid-20s, I guess, so 20-odd years old. House prices, and I'd cut out an article back in the day, which was Shane Oliver doing a prediction on house prices, and the headline was, house prices are 30% overvalued. Right? And so then it had a list of all the houses, like the average median price of houses in all the suburbs in Melbourne. North Carlton,
It's like 200,000.
No, it was a bit more than that. I'm not that old. No, it was like, I think it was like 430 or something like that.
It's crazy, isn't it?
Like,
Yep.
and North Carlton now is, I think it's like 1.4 or something like
Yep.
that. Brunswick, it's like 280. Like, South Melbourne, 370. It's like, so it's always, so like, I do tell that story because it gives some context, is that house prices have seen a really significant increase over the last 20, 30 years, right? And that is also reflected in this chart. So when we're looking at the chart, you can see that house prices have gone up, far left-hand side, relative to disposable income. So it used to be back in, the 90s, it used to be sort of just under 3 times disposable income.
Yep.
Now, average house prices in Australia are sort of close to 6 times disposable income.
Yep.
Household debt has increased as a result, but not proportionately as much. And so, it has been a success story of the Australian economy. House prices increasing over time.
Absolutely, and especially if you incorporate the wealth effect.
Yeah,
the psychology of that, where people have more assets, they spend more because they feel wealthier, and therefore the economy grows.
That's right. Yeah. So what we've seen since the federal budget was announced, and there's been a confluence of factors too, really, hasn't there? So interest rates have gone up. The federal budget was announced, and so what we've actually seen is house prices in some places in Australia, capital cities in Australia, have fallen. So the most significant fall has come from Sydney.
Yep.
So in the last quarter, it's fallen 3.2%. Melbourne, it's fallen 2.6 in the last quarter, 1% last month. Sydney was minus 1.2 last month. Canberra's fallen, but the national average over the last quarter has fallen by 0.7.
Yeah. It's just interesting looking at the annualised figures where, there's some pretty big numbers there for Brisbane and Adelaide and Perth. But yeah, just I guess it says something. If you look back maybe what these numbers had been 5 years ago, those capital cities would have been lagging, say, versus a Sydney and a Melbourne. So I guess it's one of those expectations of different asset classes, is that you're not always going to win.
I mean, I was actually surprised when I put these numbers together that the median house price in Melbourne is 800,000 versus the median house price in Brisbane. No disrespect to anyone who lives in Brisbane or Perth, but is 1.1 or 1.04, right? Like I was surprised at that. Sydney's always been the clear leader.
Yep.
But that's quite fascinating to me.
Yep.
So I think what's happened here is investors have seemingly just pulled out of the market.
Yeah.
What do you think?
Yeah, over the last quarter, absolutely.
Yeah.
Well, again, it's uncertainty. Like, no one has negative gearing's been effectively scrapped for new purchases anyway. Sorry, wrong way around. My brain's not working. Negative,
that's okay.
Negative gearing's been kept for existing properties, kept for new purchases,
Grandfathered
for we can cut that out. That's fine. Negative gearing's been grandfathered or at least changed for properties, and the tax changes for capital gains tax, all of those things has had an impact, which is its intended purpose, right? We're looking at housing affordability here, so
let's just talk about that a little bit. So is the stated intended purpose for house prices to fall, Chris? And I mean, it's not. I'll answer my own question. It's not.
I just think it's nuanced. Was the way I was going to answer that.
Of course, it's nuanced.
It's the supply is clearly an issue, especially with the amount of immigration that we have. So that's always been a consideration. Now, that's not me saying I think that immigration is a problem, because some people might read it that way. I'm not saying that. No. It's just saying the general dynamics. And I think there has to be some element of wage growth catching up in some capacity, because we can't continue to see, debt expanding and house prices continuing to go up, because it's just going to, as you talked about before, those stats around, wages as a multiple of house prices. The more indebted people become, then, the harder it is for them to build wealth in other areas, which keeps them working longer and gives them less options, and I guess the quality of life is then impacted. So I think there's a whole bunch of things here. I wouldn't say that the legislation is its stated intent was to have house prices fall, but I definitely think it was to slow it down rather than necessarily.
Yeah.
It would be political suicide to have a material fall in house prices.
Oh, look,
That would just be.
I agree. I
you'd
mean,
be-
the wealth. You talked about the wealth effect on the way up. Like the wealth effect on the way down is significant, right? Like, what about if you bought a place? I don't know, two years ago, and then the house prices fall by 15-20%.
Yep.
The median price in Australia is $1 million.
Yep.
Buy today, 2 years' time, it's worth 800,000.
Yep.
I mean, like you've still got $1 million debt, and your assets worth $800,000.
Correct.
You're feeling pretty poor.
Yeah, absolutely. And you're angry too, because
Yes,
it's like, well,
that's right.
Everyone else over the last 30, 40 years has benefited, and then all of a sudden I've bought it. Well, it's not my fault.
Yeah.
I blame you.
Government.
Yeah.
So I think we certainly as an economy we cannot afford for house prices to fall. We can't afford it because everyone is leveraged off their home to increase their wealth over time. If it goes the other way, then I can't imagine the banks would be too happy about it.
It's very interesting there that you have said out loud the perverse incentive that's built culturally into this country. That I'm sure there would be sections of the electorate would be very angered by.
Really?
Yeah, absolutely. Well, if you've got young people who can't afford to rent or buy a house, and the system is set in a way where it's too big to fail. Effectively, is sort of almost what you've said. You would feel like the cards are stacked against you, and I can understand why you'd feel resentful towards that.
Yeah.
So, as a government, how do you and if that cohort of people gets larger, for all of our children, for example, that becomes a problem.
One of the other things that I didn't put in here that would also be another cause of house price weakness is the changes to stamp duty, particularly in Victoria.
Yeah.
And all the additional property taxes that are around, land tax.
I think some of that speaks to why house prices are falling.
That's
in
right.
Melbourne.
Yeah. Right. So it doesn't make it as potentially as good an investment in Victoria than maybe others.
Well, lots of anecdotal evidence from clients. Why would you buy a property in Melbourne? Victoria. Right?
Just a couple other quick things to point out. So Domain, the website, Domain, they're forecasting house price falls Melbourne and Sydney in the next 12 months of 7 or 8%.
Yep.
The banks are not as, their economists have probably got a bit of incentive, I suppose, but their economists are suggesting that perhaps it won't be that much. It may be, price growth forecasts come back to 3% from 5% is what they've talked about across Australia. Westpac has seen a reduction in investor activity. And again, this is to the end of June, right? So it doesn't pick up all of what we've seen in the last month. But a reduction in investor activity of 34%.
That's a big drop.
Yeah, particularly when you consider, I'm not sure if that's inquiries or not, but that may well be like loans funded, and then like that will continue to go through.
Yeah,
I'm sure there's investors just aren't
Well, yeah. Why
going
would
to.
you? Yeah.
Which I guess is the point of legislation.
Yeah, correct. So I guess we'll see. But I think about that and I'm like, all right, well, how does that then play out in the wider decisions that people make?
Yeah.
Because as we're going to, I guess, talk about in terms of GDP growth and then how that's translated into asset price growth that is non-property related when, those sorts of outcomes have actually been quite strong. I guess there's some decisions there around, capital allocation and, where do people then subsequently invest? What does that look like?
Yeah. Should we move on from house prices? We could probably keep talking about
stuck
it.
here,
So let's talk about productivity growth. So productivity growth, I've done a comparison with our chart here, but productivity growth in both Australia and the US has been Australia during sort of the 2010s closely followed what was happening in the US. And in the US, I think productivity growth sat during that time at around 1.4%. In Australia during that time was about 1.2%, was closely followed by population growth. So those numbers were pretty similar. So no real increase in living standards as a result of that during that time. 2024 rolls around, and interesting, what sort of got launched in the US in 2024 was the agentive AI tools.
Yep.
So your ChatGPTs, your Claudes, your Copilots. And all of a sudden, since that time, 2024 in the US, we saw 2.7% productivity growth, labour productivity growth. And the latest data to the end of 26 is, financial year 26 is 2.2. Versus in Australia in 24, we actually had a lag. So we had a drop, was minus 1% labour productivity growth. December 25 was 1%. And so far this year, it's looking like it's going to be about the same. So one of the things around productivity growth is it allows high productivity growth typically means high GDP growth, lower inflation, and a rise in living standards. And so and it's often linked to population growth. So when we think through that, in the US, with population growth since 2024 has only been 0.65%, whereas in Australia it's been 1.5%. So what that actually means, there's a whole bunch of numbers there. What that actually means is that Australians are living, their living standards are not as good as what they've seen in the US.
Yeah, absolutely. It's been a challenge for, I guess, governments, particularly here in Australia. And I think the AI story is one that is real in terms of how that has played out through the United States. And it's really only landed here in the last 4 months.
I was thinking about that when I was putting this slide together. So, I mean, certainly we can talk anecdotally about our business. We've been using Microsoft's version of AI Copilot for the last 3 or 4 months, and it's incredible.
Well, it's just revolutionised the productivity that you can do.
And that's exactly what it is too, right? You can do more with the same time that you've got.
Yeah, correct.
So you can be more productive. We can be better for our clients. We can be on the phone more for our clients. We can be talking to them more. We can produce better documents that are more encompassing as a result of access to Microsoft's AI.
But again, anecdotally, we've got lots of clients who work for large corporates in reasonably senior positions, and everyone's at a similar position, right? It was like there's tools become available, we've been able to use it, and we're now understanding how and what are the best ways to implement. And I think we'll find that over the next 12 to 24 months that will become significantly more streamlined, and you'll have embedded processes. And then what we should see is a lift in productivity growth here in Australia, which I think will be a good thing, because it will then flow back to living standards. So then your GDP growth is going up, then you've got consumer sentiment's going to increase, then we're going to have lower inflation. All of those metrics that we've been talking about earlier today should start to improve, and then hopefully what we'll see is a rise in all of it. So living standards and asset prices and just better quality of life.
That's right. All right. Well, let's move into markets. So these numbers are to the end of June. The 1 year numbers in Australian equities is 6.1%,
which is pretty much income, really. Almost.
4% dividends. Thereabouts. Global equities did 15% last year, so that's the global share market, encapsulating all share markets. And US equities, as defined by the S&P 500, did 18.4 last year. Now, the 1 month numbers were 0.6, 3.2, and 0.5. The 3 months were pretty strong. When you extrapolate that out, you look at the 10-year numbers. It's that you're looking at 9% for Aussie, it's ASX 300, 14% for US equities, and 13% for global. US equity market, of course, making up 74%, 75% now.
Yeah, which is crazy, because it was 60, and now has just exploded. So
that's right. So just conceptually looking at in a cumulative chart form, an investment of $10,000 in 2015 into those 3 indexes, the US equities are now worth $40,000. So it's 400%. Australian equities are 25.
It speaks to, I guess, why we approach portfolio construction the way we do. where there is a lot of home bias in various countries, and probably less so the United States in terms of how they maybe look at their indexing. But clients will come in and say, well, I know these brand names here in Australia, like your BHPs, CBAs, CSL, even though CSL hasn't done very well recently.
No.
But all of those larger companies, and they feel safe there, and maybe have less of an inclination to invest more globally.
Yeah.
It's easy for us to say now, whilst the returns have been strong, but like if you look at those 10-year numbers, you're looking at 4% per annum differential. Like that's a lot of return.
Well, over 10 years is 150%.
Yeah,
Compounded return.
Yeah, to miss out on because of, I guess, an emotional bias.
Home bias that we have, because we feel comfortable with the names that we know.
Yeah,
right?
correct.
Just on that, worth pointing out this slide too, right? So the largest company in the world at the moment is Nvidia. So their market cap is just under $5 trillion. It's hard to say that
ridiculous,
out loud.
isn't it?
But you're looking at also Apple at 4.8 trillion, Google, which is now Alphabet, 4.3, Microsoft at 3 trillion. So like there's all of these companies we all know, of course. Revenue of Nvidia was $250 billion. Revenue of Apple was $400 billion. The revenue of Amazon is $780 billion. Like it's some extraordinary numbers.
It's just those numbers are.
For context, in the Australian market, so the top 10 Australian companies, BHP being our largest, right? So the market cap of BHP is $230 billion.
It's interesting. It's just when you think about the profit, what was the profitability of Nvidia?
Profitability of Nvidia, that's a good question. I can't remember. Last year was 160 billion.
Yeah, right. So
that's right.
It's half the value of a billion. Yeah, right. So it speaks for itself, really.
Yeah. So I guess the point of me bringing that up is to say that like our companies here in Australia are unfortunately global minnows.
Absolutely.
So our largest company in Australia is BHP. I think it is the 86th largest company in the world, and it's dwarfed in market cap and profit and revenue by the top 10 in the world. Dwarfed, like it makes up sort of 5% of those numbers.
And so then it's in its ability to potentially, so obviously there's ups and downs with all of this, but its ability to then provide the performance of I'm not even going to call it like Nvidia, but like maybe let's call it the 50th or 60th largest company globally, which would be something on the S&P 500. Just who knows what the name of the company is, but it shows you that there's a real risk in over or not exposing yourself to diversity across geography.
Yeah. And I mean, going back to, we talked a little bit about productivity growth before, but like in the last 10 years, we've really seen no productivity growth in Australia, which has therefore meant that we've increased our GDP numbers through population growth, and that's okay. But that is also probably telling its own story in the performance of the Australian equity market over the same period of time. Like it is significantly lagging its other counterparts.
Yeah, absolutely.
And so, again, you talked about it earlier, we do have a diversified approach, and we certainly do have an allocation to Australian equities as part of our portfolios. But it's in context of how they are positioned relative to the rest of the world too. Chris, we should talk about the disclaimer.
Not financial advice.
That's right.
Yeah. So I guess it's probably just an assumed thing at this point, given how many of these we've done.
Yeah.
But it's these are all us just trying to pick through the tea leaves really and give our thoughts on what's going on, and
where things are up.
We probably know as much as the next person, so don't take them as
well, it's not personal advice.
Yeah, correct.
Yeah, it's not personal advice. So if you need advice, you have to engage a licensed financial advisor who will give you advice based on your personal circumstances, financial situation and needs.
Correct.
Mate, thanks so much for your time. That was probably a bit longer than what we would normally go for, but there was a bit more to talk about today.
Yeah, well, hopefully it's just interesting for people to contextualise, I suppose, what's happening.
That's right. And well done if you got to the end.
Yeah. All right. Well, see you all next month.
See you next month. Thanks, everyone.